Well, it's the last crucial 1 hour of the trading session and you've tuned into 18 hour to navigate through that, and it seems like the green is back on the screen for now because HDFC Bank has managed to pull the markets higher. That result reaction coming in means that the stock has moved at the highest point of the day, and of course it's taken along Nifty with it, which is now at a level of 23,100. So finally breaking out of that range, 23,000 to 23,050 was the range that it was working with throughout the day. Now a bit of a bounce back. IT was as it is the flavor of the day and was doing well since the start of the trading session. So a Wipro is up 3.25%. Infosys is bouncing back very smartly. TCS, Tech Mahindra, LTI Mindtree. These were the names which are holding in the green. Pharma, a tinge of green there, led by Sun Pharma as well as Cipla and Lupin. So some of these names and defensives doing well in the trading session. The surprise today on the street is real estate pack. Clearly, the spaces which are overheated or the ones which generated huge alpha for people are the one getting undone, whether it was Paytm, Zomato earlier, or whether it was Dixon, Keynes, etc., which is coming under pressure. And now real estate, which has returned stellar numbers over the last couple of years, is finally seeing some profit booking. Lodha, wherein there is this fresh corporate tussle, wherein there is a fresh litigation which has brewed between the two brothers. That's causing the down tick on that one, 7% lower. Godrej Properties, Prestige, Phoenix, Shobha, these are some of the names which are in the red. But good earnings are getting a thumbs up, case in point being Jana Small Finance Bank, which is up around 18%. But Nikunj, that seems to be the flavor of the market. The quality mid-cap names, the haloed ones, the blue chips, the likes of Zomato, Paytm, even Dixon, Keynes, etc., which people used to love the story, they are the ones, which at a sign of inline number is also getting punished.
So Anisha, look, whatever may be the reason, the momentum and the underlying interest in the market has faded away. The smart guys would say it's the dollar index. The macro investors would say it is rupee. Technical experts, Kunal would agree with me, they would say technical and key DMAs have been broken. Market commentators like us would say it's pure profit booking, long term nothing changes. The bottom line here is that in a market, there is, in the short term, it's always liquidity and momentum. And liquidity in a sense is against us, momentum has broken away completely. Now you can link it up with, you could blame it on variety of factors, but that really does not matter. For me, some trends which are very clear, Anisha, we've exited the era of high return, low volatility. High return, low volatility. Like so, VIX for the longest time after 2022 has been artificially low. Normally VIX on a longer term basis, Kunal, stays above 15 to 18, 15 to 25. That's a respectable number for VIX to be.
Correct.
Right? It's been artificially low. It is now normalizing. That's mean reversion happening there, which is risk and volatility is coming back. Second, the Ringa roses and IPO, which we were talking about, that seems to be getting over. So if you look at the stocks which are getting hammered, they are companies which have recently got public. Wari, Premier, MobiKwik, just a whole host of companies where Ringa roses has started, that is getting over. Third, and very important here is that the small cap leverage market and the SME market where everybody was buying today and selling tomorrow and they were buying high and selling higher, that is also getting over. But what is not getting over is that classic buy good stocks and hold them. What will not get over is that this market will recover once things on a macro front and on a local front it stabilizes. And I think in this churn, the market will see new leadership which could emerge from new sectors. And I'll just wrap it up by one single point. Look at Nifty. HDFC Bank has stopped falling and Reliance has started rising. That's 25% of the Nifty. So suddenly the 25% of the Nifty, which was like the back burner, now comes in the front. And for me, that makes Nifty look very different from the rest of the market setup. I think the problem is that HNIs are now selling because they want to raise money and protect their gains. And it is selling which is leading to more selling, and more selling is acting like a domino effect. Like a stone you throw from the top of a hill, by the time it just rolls down, it becomes a snowball. That is the problem in small and mid cap stocks.
Yeah, that is well articulated as to what's happening in the market right now. But to the point that, Nikunj was making as far as HDFC Bank and Reliance is concerned, Kunal, would you call both of them out of the woods now and a bit of a breakout on both?
Yeah, a bit of breakout on both. And I think more than breakout, it's a breathing space which has now come back into both of these names, which were into, so there was a lot of expectations for these stocks. But then I think, even beyond the expectations, these stocks had been, seen phases of huge underperformance or maybe flat performance if you look at this over the last 3 to 4 years for these names. So I think we could probably be at a point where these stocks may come off on their own. These stocks would probably try and show some bit of outperformances. And adding to the point which Nikunj was mentioning, so when you have such kind of solid large cap names which stop falling and even if they stabilize at current levels, optically you might look at the Nifty being a bit more flattish or range bound, but the real pain is actually where the mid caps and small caps are getting hammered. So I think we are now into that dual phase of the market. We have been in that dual phase of the market since last few days, but I think that could probably get a lot more evident once these large cap names start to outperform.
Okay, fingers crossed. Hopefully they start outperforming soon, because the market definitely can do with a bit of a breather. But Sunil Subramaniam also joins us on the show right now. Sunil, this dual problem of liquidity and volatility that we are highlighting. Liquidity, I mean, more than 55,000 crore worth of money has been taken out by FIs in this month alone. Just a minute, just the numbers coming in from HDFC Bank, incremental numbers, I believe. NIMS, of course, is coming in 3.43%. The initial number that we had put out was calculated. Now I think the press release is out and that's the latest number coming in. But the stock is doing quite okay because the expectation was around that number in any case. So Sunil, just coming back to the point, of course, FI outflows have been quite substantial, but DIIs have been holding ground. Do you see a case potentially that DIIs will also throw in the towel, or that's not likely to happen?
So I have a slightly different take on this, right? So the first thing is that FIS selling started from October. And it started because of weak corporate earnings. There was an initial China news stimulus at that time, if you remember, when they were pulling money a little bit out of other markets and putting it to China. And then that quarter results came in very weak for the stock market, and hence FIS selling spiked up. The selling further spiked up when the Trump news came, because there was a reversal of flow back into the United States, strengthening dollar as well as good yield on the debt side in the United States. But the markets, though for us, it looks like there's been a big correction. Actually, the markets haven't fallen as much as FIS expected them to fall. The reason for that is DII buying right through this period, right? So from an FI perspective, he felt the market was overvalued. He kept selling. But the market continued to remain overvalued because it was not allowed to fall by consistent DII support. Now come in January, and then what's happened now is that the FI selling is continuing, but now DIIs have stopped buying all that the FIs are selling. That's why you're now seeing a further. So it's the lack of action, buying action by the DIIs, which has now led to a further fall. The FI selling has been sustained. Now, why is this? And I took some data out here. So mutual funds itself are sitting on 200,000 crores of cash. Okay. Now, that money, they are not putting into use. Why? Because they are waiting for the event calendar, that is, the earnings season, to reflect which stock to buy. Because based on last quarter's earnings, all these stocks were looking reasonably overvalued. They want to see the earnings season, number one. Then you have the economic survey coming out before budget. Then you have the budget, which is going to give a direction. And then you have the RBI policy. So DIIs are sitting and waiting, and they are letting the prices fall because, one, good quality stocks, if they're getting it cheaper, a fund manager is looking to buy from a 3 to 5 year perspective. Remember that. So the lower he gets the price of a good quality stock, he's happier. So today they are not yet stepping in to buy everything the FI is selling. Not only that, I believe that now they have started booking profits in good mid and small cap stocks which had rallied a lot. So the selling in the mid and small cap, partly by FIs. FIs don't have that much exposure to mid and small, but they do have some exposure. Plus, domestic MFs are also generating cash to buy the right stocks once you have this event calendar filled in. So I am of the view that the DII support is actually now not so much there, and that's why the markets are falling. But they will come back strongly once there is clarity from all these events. So I think post-budget, post-RBI policy, by which the earnings season would have also seen 50-60% of the earnings come through, you will see strong buying support step in from DIIs post-February 7th, onwards, post the RBI policy. And they'll then go buy good. What are they buying today, if at all? They're buying good quality names which know that they're not going to get affected. You mentioned a couple. So I think there's a limited buying of good quality, but this shift from a momentum to quality is, I think, the underlying change we are seeing. And I think the rest of the first half of this year is going to be a extremely quality-driven rally. And how will you determine the quality? first, the good quarterly earnings. Second, a good guidance on the order books, right? And third, you should see that they are continuing to manage their businesses well. So I think these good businesses are going to get priority as and when the DIS step in. Now, as the earnings season comes through, if some companies already report good earnings, good guidance, they will step in and buy. So the IT related buying, some of the pharma buying, all of this is because one, they are not domestically linked. So their all these event season is not so critical for them, but at the same time, their guidance has been good by and large. So that's where the fund managers are buying those, and that's why you see some buying support on external oriented sectors, which are also little.
All right, I'm just going to mark the Nifty here for a second because we've seen an elevation of about 150 points from the days. So Nuresh, again, we are going back to 2300, 23,100, just in and around that mark, and this market has found support for 7 days now. So is the line in the sand getting created that are we getting to some base building?
So yes, 22,700 to 23,000 is roughly the support area as well. This is where the Nifty was pre-elections, and then we saw the election dip. And more importantly, we'll see a better trend once the budget is over, because that's an event which is the market is waiting for. Post that, there will be more clarity in terms of momentum. So for now, the next 10 sessions, we could get into a range of 22,800 to 23,400, 600, and just keep seeing such moves and only result reactions. So for now, it's a time to make a base and then get a trend post-budget.
So Kunal, there is no pre-budget excitement this time. Could there be a post-budget rally? We think there's a pre-budget rally and then markets buy the rumor, sell the news. There is no rumor this time.
Yeah.
There's no rumor this time. So will markets rally after the news?
I think they should, rally, because there are a lot of points when.
Very matching tie here. I just realized.
This is yellow.
No,
Yeah, but
it's
this is
different. Yours is bronze.
The pattern
His
is.
is yellow.
I just realized. Haji.
The pattern is similar.
Yeah. So I would believe that, and we were discussing this data, I think yesterday or day before, that, pre-budget, when we looked at this over the last 31 budgets, market reaction, we've actually gone into the budget on a negative note for 21 times out of the last 31 times. So that itself indicates that there is hardly any pre-budget rally. But the setup for post-budget now, I think, would start to look a lot more better, because, the point which you were making earlier, that large cap names, at least the very strong heavyweight names like Reliance, HDFC Bank, you add to that, the IT majors, Infosys, TCS, they are showing signs of recovery. Then you have other, pharma stocks like Sun Pharma, etc., which are also showing signs of solidity. So when you have, say, approximately 40%, 45% of the index weightage still showing signs of strength, not buckling under the selling pressure, I think that itself would probably shield the market correction broadly. And then I think, there would probably come a point where the mid caps and the small cap selling would get into a deep oversold territory. And I think that would itself calling for a much more sharper recovery. So I think now, with every passing day going by for the indices and the intensity of selling pressure increasing on an intraday basis, the chances of a post-budget recovery becomes extremely on the higher side.
Post-budget recovery, but before that, we almost have 8 to 10 days to go for that. So maybe the pressure might just continue in the very immediate term. A quick break and we'll be right back to track the last 45 minutes of the trading session. Well, one of the weakest link of the market today is the real estate pack, which is down about 5%. But not just today, for the week as well, we have seen index decline by as much as 9%. The earnings so far or the operational updates have been in line to slightly weak, and there have been initial signs of crack, with reports suggesting that inventory is building up, at least on the higher side of the real estate pack. Let me take it across to Snehi, who tracks the sector closely, to get more insights. Snehi, explain to us, what do you think is the reason of the kind of crack that we are seeing in the stock prices in real estate?
Well, absolutely, and it's not one or two reasons that's ailing the entire Nifty realty pack. It's a whole bunch of reasons coming in. First up, let's understand why real estate as a sector specific is seeing a beating across all stocks, because this is not a stock specific fall that the real estate index is seeing. Now, real estate in its nature is a cyclical trend and usually is a 7-year cycle. What we understand from management interactions and brokerage notes is that we are somewhere at the beginning of the 5th fifth year of this cycle, which means now it is time for that peak to come down, and that could indicate a slowdown when it comes to bookings, demand, as well as all the factors that are important to track in the real estate market. Now, when you take a look at the Q3 FY25 numbers also, be it Q3 numbers coming in or even the Q3 updates that the companies have posted, these numbers don't look very promising. For example, if you take Sobha's Q3 update, the total sales value was down 28.8% year on year. Oberoi Realty's Q3 numbers that have come in recently, their pre-sales is also below, is 13% rather below street estimates. So that is also looking weak right now. If you take a look at the macro scenario right now, it's a heightened inflation and overall slowdown in urban consumption also seems to be weighing on the overall real estate demand. There's also some delay in regulatory approvals that we are seeing. This is largely coming in from Bangalore. Now managements for real estate players based in Bangalore say that this is all in the past, but the overhang of these regulatory approvals and the delays that this causes in the new launches is still being seen when it comes to quarterly updates. There's no outlook on the rate cut by the RBI yet. Remember that higher interest rates make home loans more expensive, and that in turn could also be dampening demand. And lastly, affordable housing companies continue to be under pressure, and that is why credit for affordable home loans also seems to be on the back burner right now. So these are some of the reasons why the Nifty Realty is seeing pressure. And if you see stocks like DLF, that's lower by 26% from a 52-week high. Macrotech Developers is 35% lower. Nifty Realty overall, if you see that pack, is 25.5% lower from its 52-week high. That's below. So that's these are all the reasons that are ailing the Nifty Realty. And overall, it's very important to remember that this is a cyclical trend. It's a largely cyclical index in nature, and which is why the Nifty Realty is ailing away.
A lot of real estate players are saying it's the stock market boom which is driving real estate. And if the stock market boom is getting over, do you think real estate stocks also could hit their peaks?
Is it for me, Nikon?
Yes, sir. How many Sunils do we know, sir?
Good. No, I think
You may have forgotten my name. I don't forget you.
Not at all, Nikon. No, I didn't know the question was for me. No, I'm just saying, see, I don't think that the stock market boom is driving the real estate. I think that there is a lending boom, part of the money which is coming into the stock market. So to the extent people are using existing real estate as collateral, as a loan against property, and putting that money into the stock market, maybe. But that I don't think is the reason for this. And this correction in real estate is just because there's an anticipation on the RBI policy, and fund managers, like I told you, Nikunj, are looking to book profits to buy the good stocks. Now, some of those real estate stocks might turn out to be good stocks if there's a favorable RBI policy. But at this point in time, they're just generating cash from where they have made a lot of gains and keeping that in the sidelines and waiting for all of these triggers to play out and then step in and rebuy them. So I'm not saying that this is any call on the sector itself, right? The budget, for example, would it do something to boost affordable housing? Then you could see a rally. If the RBI is talking about a softer policy with a possible rate cuts in the future, that could be positive because the rates in the sector. So I think it's early to call this as any downturn, but since there has been a strong rally, I think the DIIs are booking profits in these so that they have enough ammunition in the barrel to buy the right stocks. And real estate, some of the real estate companies could be the right stocks to buy at the right time, just in a couple of weeks' time.
Naresh, in this market fall, the heroes or the cult stocks, Zomato, Dixon, Keynes, the whole cult feeling in the HNI community now seems to be getting challenged. It got challenged in retail stocks a couple of months ago when Vodafone, Yes Bank, Suzlon, JP, they started reversing. But now it's the HNI quality end which is now reversing. Where else do you think, Naresh, the over ownership is still high, patterns have not reversed, and a scare cannot be ruled out?
So the pocket was EMS mainly, which was wherein stocks had gone up 5x. We've seen the first correction. New age companies was another. We've seen that correct. So PB Fintech went from 400, 500 to 2,000 rupees. You saw Paytm even go from 400 to 1,000 rupees. Zomato went from 50 to 300. So all the pockets which had gone up 5x in the last, say, 2 years are taking the hit. And for them, going down 30% would be pretty normal. And post that, going into a correction zone. We've seen that happen with a lot of defense names, and now in the current bounce back, they've not been able to make a strong bounce back, but they are consolidating now. Similar thing is happening in EMS. Maybe renewables is one more space where it could get a lot more worse going forward.
Point taken. But slowly and steadily, some of these quality names, even a trend for that matter, has come off 20% this month. At least I didn't realize that that's the kind of decline that stock has seen. Apart from, of course, the real estate pack, as well as some of the names like Motilal Oswal, etc. Kunal, anything that is now entering the buy territory from some of these names?
Yeah, I think trend itself is I would believe a stock which has come back into a bit of an oversold territory. The RSIs on the daily charts have hit levels closer to 24, 25 for trend at current levels of 55, 80 thereabouts, where the stock hit a low. So I think in that sense, I would probably expect the stock to come back into a deep oversold territory and see a bounce back. Then there are many of the other names. I was looking at the charts for Polycab, and that's a chart which has started to come back into a attractive buy zone. The stock forming a double bottom for itself. Indian Hotels is the other stock which I also believe that looks fairly attractive. That with the stock forming a double bottom at this 750, 770 support territory, forming a strong candlestick pattern, formation today specifically. So I think that's another indication. So there are many stocks which are now coming back into a retest of the previous month's swing lows, as well as a point where the indicators are oversold. And I think these are the kind of stocks which were doing pretty well in the previous cycle, and these stocks after a correction of 25% broadly, I think it start to look very attractive.
Okay, attractive, but who's going to buy? Who's going to take the first plunge? That's the big question that everyone is asking. But Sunil, on that note, we let you go. Appreciate you making time for us today.
If you like this video, then like, share and subscribe to ET Now.